Welcome to the Limitless Retirement Podcast. My name is Danny Gudorf, the owner of Gudorf Financial Group. Whether retirement is on your horizon or you've already made the leap, this podcast tackles your most important questions in retirement. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Advisory services through Cambridge Investment Research Advisors, Incorporated, a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated. Advisory services offered through Cambridge Investment Research Advisors, Incorporated, a registered investment advisor. Gudorf Financial Group, LLC, and Cambridge are not affiliated. Reviews on this site may or may not be by clients of the firm. No compensation is being provided for sharing of opinions and experiences on this site. The reviewer's comments may not be representative of any other person's experience and is no guarantee of future performance or success. Investing involves risk. Depending on the different types of investments, there may be varying degrees of risk. Clients and prospective clients should be prepared to bear investment loss, including loss of original principal. Cambridge does not provide tax advice. So let's go ahead and get started with today's show. If you're thinking about doing a Roth conversion this year, there's a hidden trap that catches a lot of people off guard. You could pay every dollar you owe by December 31st and still get hit with an underpayment penalty from the IRS. I've seen this happen to clients who thought they did everything right. They converted their IRA to a Roth, paid the taxes on time, and then months later got a penalty notice in the mail. So in today's video, I'm going to walk you through exactly how this happens, why the IRS penalizes you even when you pay on time, and most importantly, how to avoid this mistake so you can keep more of your hard-earned money. I'm Danny Gudorf, founder of Gudorf Financial Group. For over 15 years, my team and I have helped people over 50 build a limitless retirement. Let's start with what a Roth conversion actually is. A Roth conversion is when you take money from your traditional IRA or your 401k and you move it into a Roth IRA. When you do that, you pay ordinary income taxes now on the amount you convert. But once that money is inside the Roth, it grows completely tax-free. You never pay taxes on it again. You don't have required minimum distributions. And when you pull money out in retirement, it comes out tax-free. That's why Roth conversions are such a powerful strategy. You're locking in today's tax rates and protecting yourself from future tax increases. Now, here's what most people don't realize. When you do a Roth conversion, you're not just adding income to your tax return. You're also triggering a timing issue with the IRS. The IRS expects you to pay taxes throughout the year as you earn income. They don't want to wait until April 15th to get their money. That's why employers withhold taxes from every paycheck. That's why self-employed people make quarterly estimated tax payments. The IRS wants a steady flow of tax revenue all year long. So here's the problem. Let's say you wait until December to do a big Roth conversion. Maybe you convert $100,000 from your IRA to your Roth. That's a smart move for a lot of people. But the IRS looks at that conversion and says, you earned $100,000 of income in December, but we're going to treat it like you earned it evenly throughout the entire year. So in their eyes, you should have been making tax payments back in April, June, and September, even though you didn't actually have that income yet. And if you didn't make those payments, they can charge you an underpayment penalty. Right now, the underpayment penalty is 7% annually. That resets every quarter. So if you owe $20,000 in taxes on your conversion and you didn't pay enough throughout the year, you could owe hundreds or even thousands of dollars in penalties. And this penalty applies even if you write a check for the full tax bill on December 31st. You paid on time, but the IRS says you didn't pay early enough. I had a client a few years ago who did a $150,000 Roth conversion in November. He was retired, so he didn't have any withholding from a paycheck. He paid the full tax bill in December from his savings account. He thought he was all set. Then in May, he got a letter from the IRS saying he owed an underpayment penalty of over $2,000. He was frustrated because he did everything he thought was right, but he didn't know about this timing rule. So how do you avoid this penalty? There are really three main strategies you can use. The first one is called the safe harbor rule. If you pay 100% of last year's total tax liability through withholding or estimated payments, the IRS won't penalize you. If your adjusted gross income is over $150,000, you need to pay 110% of last year's tax. There's also another version of the safe harbor rule. If you pay at least 90% of your current year's total tax liability through withholding or estimates, you're safe. So if you know you're going to do a Roth conversion, you can look at last year's tax return and make sure you're paying at least that much this year. That protects you from penalties. The second strategy is to file IRS Form 2210, specifically Schedule AI. This is a little more paperwork, but it works. Schedule AI lets you show the IRS that your income really did arrive later in the year. You're basically saying, I didn't have this income in April or June, so I shouldn't be penalized for not paying taxes on it back then. The IRS will recalculate your required payments based on when you actually receive the income. This strategy works, but it does require you to fill out extra forms when you file your taxes. Some people don't want to deal with that hassle, so they use the third strategy instead. The third strategy is to withhold taxes directly from your IRA when you do the conversion. Here's why this works. When you withhold taxes from an IRA distribution or a Roth conversion, the IRS treats those withheld dollars as if they were paid evenly throughout the entire year. Even though the withholding happened in December, the IRS acts like you paid it in January, February, March, and so on. So if you withhold enough to cover your tax bill, you avoid the underpayment penalty completely. Now, I'll be honest with you. Withholding from your IRA is not my favorite strategy. Here's why. When you withhold taxes from your conversion, you're shrinking the amount that actually makes it into your Roth. Let's say you're converting $100,000 and you're in the 22% tax bracket. You owe $22,000 in taxes. If you withhold that $22,000 from the IRA, only $78,000 ends up in your Roth growing tax-free. But if you pay the taxes from a separate account, like a savings account or a taxable brokerage account, the full $100,000 goes into the Roth. That's a big difference over time. You're moving money from an account where you pay taxes on interest and dividends every year into an account where everything grows tax-free forever. But here's the thing. If you don't have the cash to pay the taxes out of pocket, withholding is still a good option. It's better to withhold and avoid the penalty than to get hit with a surprise bill from the IRS. And if you're doing a conversion late in the year, withholding can be the simplest way to stay compliant. If you're under age 59 and a half and you withhold taxes from the conversion and don't replace those withheld funds within 60 days. That withheld amount is treated as a taxable distribution and may be subject to the 10% early withdrawal penalty. There's also a more advanced strategy that some people use. If you have the money to pay the taxes out of pocket, but you don't want to deal with estimated payments or extra tax forms, you can withhold taxes on your conversion and then do a 60-day rollover. Here's how it works. You convert $100,000 from your IRA to your Roth. You withhold $22,000 for taxes. That $22,000 goes to the IRS. So it's considered a withdrawal, not a rollover. But within 60 days, you take $22,000 from your savings account and you deposit it into your Roth IRA. That's called a 60-day rollover. If you do it correctly, no taxes are owed on that $22,000. You end up with a full $100,000 in your Roth, and the IRS is happy because you withheld taxes. This strategy works, but it's more complex. The general once per 12-month limit on 60-day IRA to IRA rollovers does not apply to rollovers from a traditional IRA to a Roth IRA conversions. So if you're thinking about this, talk to a tax professional first. Here's the checklist I would follow if you're planning a Roth conversion. First, check if you're covered under the safe harbor rules. Look at last year's tax return. If you're paying 100% of last year's tax liability this year, or 110% if your income was over $150,000, you're protected. You can do your conversion whenever you want and you won't owe a penalty. If you're not covered by safe harbor, you have a few options. You can do the conversion in the fourth quarter and withhold taxes from the IRA to avoid penalties. You can file Form 2210 with Schedule AI to show the IRS that your income came in later in the year. Or you can make quarterly estimated tax payments throughout the year. Personally, I think quarterly payments create more work than necessary. There's more room for mistakes, but it's not a terrible option if you want to spread out your tax payments. The bottom line is this: Roth conversions are one of the most powerful strategies you can use in retirement. But the timing and the tax handling matter just as much as the amount you convert. Do it wrong and you risk penalties. Do it right and you get more money growing tax-free for the rest of your life. Now, before you go, I want to make sure you're not missing out on other tax planning opportunities. One of the biggest opportunities I see is optimizing your withdrawal strategy in retirement. Which accounts should you pull from first? Should you spend your IRA money early or let it grow? These decisions can save you tens of thousands of dollars over your lifetime. I created a video that walks through the exact withdrawal strategy that smart retirees use to keep more of their money. It's called The Withdrawal Strategies Rich Retirees Use That Poor Retirees Don't. Click on that video now to see how you can apply these strategies to your own plan. I'll see you over there. Thank you for listening to another episode of the Limitless Retirement Podcast. If you want to see how Gudorf Financial Group can help you get the most out of your money, go to gudorffinancial.com/get started. This is where you can schedule a 20-minute call to see how our firm can help prepare a free retirement assessment. Please remember, nothing we discuss on this podcast is intended to serve as advice. You should always consult a financial, legal, or tax professional that is familiar with your unique circumstances before making any financial decisions. discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Advisory services through Cambridge Investment Research Advisors, Incorporated, a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated. Advisory services offered through Cambridge Investment Research Advisors, Incorporated, a registered investment advisor. Gudorf Financial Group, LLC, and Cambridge are not affiliated. Reviews on this site may or may not be by clients of the firm. No compensation is being provided for sharing of opinions and experiences on this site. The reviewer's comments may not be representative of any other person's experience and is no guarantee of future performance or success. Investing involves risk. Depending on the different types of investments, there may be varying degrees of risk. Clients and prospective clients should be prepared to bear investment loss, including loss of original principal. Cambridge does not provide tax advice.